The Mag 7 being that it's the highest concentration of any sort of 5 or 7 stocks in history, basically. There's always been, Tesla rallying after the election, Nvidia obviously having another cracker year, has really disguised that, disguised that broader weakness.
Hello everyone and welcome to our live webinar. We are now in December, which seems a bit strange to say. I'm not sure where 2024 has gone, but just a quick reminder before we get started, give us a follow on the eToro X page if you haven't already. Stay updated there with the latest on markets, and of course head over to our YouTube channel as well, where you can get a wealth of content. Today I am chatting with Mark Gardner. He is the CEO of MPC Markets. Mark boasts over 25 years of experience in fixed income and equities trading. He specialises in top-down, thematic and macro analysis. Not only does he cover Australian, he also covers global market trends, and he helps investors navigate not just bull markets, but also those pesky bear markets as well. And if you haven't already, give Mark a follow on X. He puts out some great content, so make sure you have a read. He is tagged in this live. Mark, great to have you with us today. How are you doing, first and foremost?
Doing well. Looking forward to 2024 winding up. It's been a busy year, so obviously markets have had a really good year. So, despite there being a few little hiccups along the way, they've been just merely that, just hiccups really. So very much looking forward to Christmas and heading into 2025.
Absolutely, yeah. It's nice to sort of have a break every now and again. But we'll jump into that 2024 straight away. As you say, it's been a great year for global equities. If we look across the board, most global equity markets, major equity markets are in the green. Our local market as well, performing pretty well this year. But I think maybe going away from that, I wanted just to ask you what surprised you the most about markets in 2024?
Overall, just the melt-up. This thing's had a lot of things thrown at it this year, and in any normal circumstances, we would have probably seen, we would have seen a pullback or, that lasted longer than a day or two. Even that sort of dollar-yen or the yen carry trade, look, it really was gone in 3 days. So realistically, that in markets past, that would have shocked markets for a good probably 2 or 3 weeks at least. I think the rise of algorithmic trading has really shortened the timeframes of these sort of panics, and we even noticed back in Brexit, which is a while ago, that it was volatile for a week and then it was just over. So those algos do contain things quite nicely within those, as long as it doesn't go beyond 2 standard deviations. So yeah, it's I've just been genuinely surprised. I mean, we're looking at it at the moment. I think we would be within 1% of the best year for the S&P in 20 odd years. It's the best 2-year market in 20 years definitely, and it's probably the best 2-year market. I think I did a few stats. It's the best 2-year market in nearly 50 years in a hiking environment. Obviously, we've got some easings towards the end of the year, but kind of already there. And it's the best 2-year market in 20 years by 7 or 8%. So I was just very surprised at just how resilient. I mean, we've had hurricanes, we've had Middle East conflicts, we've had ongoing Ukraine, we've had Trump be elected and basically threaten everyone with trade sanctions, etc. And the market's just like, don't care. Which but that really did surprise me. It's very much it was just risk on. The risks have just been largely ignored this year, and we'll see. At this point, I really can't see anything that short that can really rattle it at this stage. Certainly not until Trump gets in January. So he can cause a whole heap of trouble regardless. Before he even gets in. So we'll see how that goes.
Yeah, absolutely. And you're right, it feels it's going to take something quite big to sort of slow this market down, and it has just sort of continued to chug on, continuous sort of record highs over that time. And you make a great point, that surprising fact of how quickly those sell-offs were sort of bought up, and that Japanese carry trade was a great example of that. Of we sold off and then we were basically back, even higher than where we were before that even happened a week later. So it's so surprising.
Oh yeah, it was like if you looked at the weekly, it was down 15% in one day, and then it was on a 5 to 6 day basis, I think it was back to flatter up. So the US market particularly it just opened low and I think just peeled directly higher. So that obviously is a show of faith from investors in the market at the moment. And I think what the Mag 7's done for this market is really provide support essentially. Like we have had broad weakness, and if you look at the Russell, for instance, or even if you want to broaden out the Wiltshire 5000, which no one looks at, but except for Warren Buffett, but he's 90-something years old. It has been a fairly weak year. So, but yeah, the Mag 7 being that, it's the highest concentration of any sort of 5 or 7 stocks in history, basically. There's always been, Tesla rallying after the election, Nvidia obviously having another cracker year, has really disguised that broader weakness in the economy. And look, the markets, this is probably one of the best examples of equity markets decoupling from the economy that I've seen in recent memory. So, I mean, my second day on the trading floor was the Asian currency crisis in '97. So it's literally, my career was largely born out of in the middle of a black swan. So yeah, I mean, there's familiarities to '01, not really '07 to be honest, but yeah, there's a few things that. One of the ones I laughed at the other day was a couple of fund managers taking pot shots at Warren Buffett going back to cash and being in the highest level of cash he's ever had. Back in 2001, and I'm sure I'm showing my age here, but most of the viewers probably won't go back that far. But everyone was sort of taking the piss out of Warren Buffett for not being on the tech run, and as it panned out, he was on the tech run. He just bought it in 2001 and 2002 when it was significantly lower. And one thing I do like about the '01 example is that if you look at the Mag 7, realistically, all of those companies half of them didn't even exist in the '01 bubble. So this AI thematic, I think, we haven't seen the companies that are going to be the Mag 7 in 20 years yet. So I quite often get asked, what's the company? At the moment, it's the bricks and mortar stuff, and possibly Microsoft because it's on everyone's desktop. But yeah, it's going to be we're in one of the best analogies I heard this year was we're in the bottom of the first innings of a game of baseball. There's 8 innings to go on this thing, and it will happen faster than the tech bubble. The tech or the internet thematic, because that's by the pure nature of AI. Things will move a lot quicker. You're not relying on people. We use a lot of AI here now because we've got a small team, and the efficiencies you can pick up are quite incredible. So it'll be an interesting ride.
Do you still think it will be a sector that we watch very closely in 2025? It has kind of dominated the conversation in 2023 and 2024. Obviously, when sort of ChatGPT, that emergence of that sort of came out, that was sort of when we really started to see it take off. Obviously, we know it's been there for a long, long time. Nvidia's been working on AI for sort of 10 years or longer, decades. But really, that ChatGPT emergence was sort of what took it mainstream and really, it sort of really sort of made its way into industries and sort of started to change things. Does it still sort of say the main sector and the main theme we focus on in 2025, or is there something else that you think may sort of take the focus away a little bit?
I think it'll be same but different. I think the Nvidias of the world and the early winners here in the Mag 7 will be that. I don't think they're going to get crucified. I think the froth will start to come out of those guys. I think the early monetizers. So Nvidia realistically is the only one monetizing AI at the moment because everyone needs their chips. So that in itself is a massive risk from a manufacturing point, but we might get to that later. But look, there's a couple of companies we like in the US particularly, and people laugh when I say John Deere or Deere & Co. But what COVID really taught the farmers was their dependence on labour was a problem. and getting cheap labour. But I recently did a trip out to some of the biggest, cropping, properties in New South Wales, and sitting in a tractor, and it looked like a trading setup. There's 4 screens in there. The guy that you don't touch the steering wheel. It was all GPS tracked. Their next step up tractors were, they're millions of dollars, but they're, they fly drones outside them, taking oxygen levels when they're harvesting. They're analysing the health of the crop. So that farming game has become a data game, and these guys have now they're using the facial recognition technology from your phone to identify weeds, so they use less pesticides and herbicides. But this is saving the farmers. One property, it was at 150,000 a year, or thereabouts. So big operations can save a lot of money, and I think with Trump chest beating about tariffs as well, 75% of their manufacturing's in the US. Be a massive advantage for them, as well, being a domestic manufacturer. So that's why, and it's they're simple things, but there is a monetary benefit to the AI immediately. And another one was in that intuitive surgical, which really I would imagine for the hospitals, from an insurance standpoint, they performed about 2.2 million surgeries last year, which is less than half. I think Henry Jennings mentioned it at the eToro Diamond event that night as well, which we've got it on our US or our global high conviction list, and essentially the more procedures this gets approved for, that will really roll out and be monetised as well, because there's benefit to the hospital from an insurance point of view, less mistakes, and that at the moment is 2.2 million surgeries. Might sound like a lot, but it's less than 0.5% of total surgeries in the world. That company can double, triple, quadruple, in a heartbeat. So that's a monetizer. I think these the AI agents are the next phase of AI. They're the things that at the moment the AI and GPT are an aggregator, a data aggregator essentially. They're not a bit of a step up from your Chrome browser or your Google browser or whatever. But those agents that then take that information and go and do something for you with it. I think Salesforce has launched a pretty comprehensive agent, but they've also complained this year that they've kind of been at the cutting edge of AI, and their clients aren't using it. So I think the tech industry moves so much faster than humans can pick it up, I suppose. Guys still wanted paper statements up until about 2005, and they all had emails. Just that adoption from the general public, where those blue sky earnings can come and it can be genuinely monetised. But I think for the next year or so, it'll be businesses that make savings and monetise, so their profit margins might go up. But I don't think we've even started to see any AI at the consumer end really that's particularly innovative. Like I say, I think Microsoft's a pretty safe bet, because who doesn't use a Microsoft product on a daily basis? It's just impossible not to.
Yeah.
Google, I'm a little bit concerned about. I think it might actually eat into their search engine volumes, because the likes of Perplexity .ai, which is one that we use here, is really, it's actually pitching itself as almost a search engine replacement. And Google's really sort of screwed the pooch a little bit with AI so far. Every launch they've had, they haven't, they're not the Google of old where they were the cutting edge. I think they're going into that sort of mature phase where they're not as agile as they used to be. But I thought that about Meta, a year or so ago, and look, and the new glasses that they release, well, they haven't released, but they're still testing. I mean, that's amazing technology. So look, it'll be, these companies are massive now. They're not going to be as quick anymore. But it's certainly going to be like where it's going to be in 10 years. If anyone tells you that they know, they're lying, because no one knows.
I think, like you say, it's that sort of AI sort of really sort of transforming industries, isn't it? We sort of went through quite a few sectors there. We spoke about farming, we spoke about hostels, we spoke about sort of general sort of tech as well. So I just think that is the theme that maybe we can look at, is that sort of broadening of the AI play, outside of Nvidia into those industries where it can sort of really have that effect on companies' bottom lines. As you say, it's not just saving. If farmers are going out and spending more money and it saves them long term, perfect for John Deere. And those capex that we might have seen increasing, that then starts to show through on the bottom line and improving margins as well. Mark, I'm going to bring it back home a little bit. I want to speak slightly to the Aussie market. It's been, again, we sort of know the Aussie market for being slightly more traditional. We're very focused on those banks and the resources, and we've kind of had an opposite performance this year. Those sort of financial names have obviously done very, very well. On the other side of that, we've had the materials sector, which has been a bit of a drag on the index. We've obviously still got rates near decade highs. Obviously the RBA haven't decided to cut rates yet, maybe coming in the first half of 2025. How do you see the Aussie market playing out in 2025, especially if we don't see rates coming down until maybe in the middle of the year?
Look, I mean, someone tabled the other day, I think it might have been a HSBC head economist, that we may miss the easing cycle. And I mean, look, having said that, if you bring it back into actual context, we didn't go as hard as everyone else anyway. So it really, all we're doing is not giving back, not reversing, rate hikes that that others did. So, but I do think there's a real risk of inflation rearing its head again next year, particularly Trump calling tariffs and things like that. It's just short term, it's always inflationary. And I don't believe that I think the Fed's done the right thing going hard early, because they always tend to not do enough early on. But I don't really see, instead of the 25, and the reason I'm talking about the Fed here is because, let's face it, rates realistically are dominated by the Fed overall, and that dictates the global economy. But we had GDP growth this morning, slightly missed expectations, but 12 quarters in a row of growth. Australians are traditionally pretty whingy. We've got 4.1% unemployment. We've had the longest stretch of any first world country for economic growth. We hold the world record. We missed the GFC. I think it won't necessarily be boom. I think that banks to resources trade will, if you were going to do a spread trade, you'd be selling banks, and because it's a 30-year, banks have just decoupled to the point of a 30-year gap, basically. I think the banks this year, or the financial sector, is responsible for somewhere between 60 and 70% of the total gains of the ASX. But one really interesting thing, and I did a bit of a deep dive into the BRICS and Trump threatening BRICS, etc. And one catalyst, I believe for this will be China. I think we've seen rock bottom in China at this stage. While the market's not thoroughly impressed with the stimulus, I think the stimulus there is smart stimulus. It's not just an open fire hose of money. They're giving money to the local council, the local governments. That reduces their interest rates, essentially by going guarantor, it'll be slower. It'll be a slower but more resilient stimulus overall. But I don't think we'll start to see the economic improvement take a dramatic turn until probably mid next year, and that's what matters to the resources sector. But this BRICS conflict, Trump's talking 100% on BRICS and rattling his spear, but Australia produces 56% of the world's iron ore. The next 5 countries are Brazil, Russia, India, China, and South Africa. So they're going to need steel, and there's been some Chinese bans on high-grade steel exports to the US today, actually. and mainly for military, but because they're quite hardened steel, so I guess I'm assuming shipbuilding, etc. So America's going to need iron ore, and they're going to need to make their own steel if he goes through with this. We're already at mid-single digit PEs in Fortescue and BHP and the likes. Iron ore's recovered probably 10 or 15% over the last month, and they've gone nowhere. And BHP particularly, one big thing with AI is it's got to be powered, and copper's going to be massive. And I think there will be a structural shortage in copper because the price has been so terrible for so long. No one's bothered to open a mine, and it takes 12 years to open a mine. So, these data centres, we've already seen Microsoft and Amazon look at basically restarting public infrastructure, nuclear power plants like 3 Mile Island and stuff. So I think that mining sector is probably in for a really good year because everyone needs us. We're friends with everyone, and particularly from that iron ore perspective. And look, I think that there'll be a little bit of a turn back to real assets. At the moment, we're all in, we're in the decouple from equities to real assets is probably at one of the highest levels in multi decades. And I think we'll start to see a return to that commodity sector because I think it's really underdone. It's very, very cheap, and we're going to have to build out that infrastructure to power all this AI. I mean, we're talking those NVIDIA chips. The NVIDIA chips manufactured this year basically use Philadelphia's entire power for a year. Just those chips alone. So it's a mid-sized American city that you're adding to the grid. It's going to have to be powered, and it's going to have to be. You can't do renewables. I mean, data centers don't tend to like fading power. You need base load, so it'll be nuclear. I would have thought, and obviously, and then it's got to be wired as well with the copper. So I think those two thematics, particularly, and with iron ore, which has really only unfolded in the last week or so, that's where the Australian market will get a boost, I believe. But it won't look as good. It won't drive the market because I think those banks at the moment are insanely high. And I think the likes of CBA, where 10 cents of every dollar is going into CBA now, from an index ETF point of view, and super's been increased to 11.5%. It's going to continue to go up. I think the likes of those big four banks, they've kind of just run out of sellers because they're way through realistic valuations. Highest PE and forward PE ratios in history. So, but what will happen if we do have a pullback is there'll be no bids. The institutional guys aren't going to be stepping in for probably $30 to the downside in something like CBA. So it'll be, it'll get very, very thin to the downside, and you'll probably see that resources to financials correct really, really sharply. So. Yeah, we probably went a little bit early on that here at MPC, and which has kind of hurt us against the index. But give it 3 to 6 months, and I think we'll be laughing, to be honest. And it'll go from there. But I think rates doesn't make a huge difference here. I think the unemployment rate's what you need to watch. Okay. And look, if we get a Liberal government back in here, or obviously a Conservative government in the US at the moment. A lot of the growth has been driven by government jobs in both economies. If the Department of Government Efficiency, the DOGE, if Elon comes in and sacks 2 or 3 million people from the government, that will be more important than interest rates. That will be the point where you go, we're going to head to a recession here, because the government's been propping it up, and that US debt spiral can't continue. That is just categorically out of control, and probably a credit downgrade in the US is probably one of those black swans that you want to look out for, because if at this current rate, 2028, half of their tax revenue is going to go in interest payments alone. Wow. So credit downgrades are going to be, and that's where I think that's what BRICS is worrying about, I think, and what China's worrying about is the US just can't be running around like a punk teenager with their parents' credit card. They've got to pull their head in at some stage, then and be a good global citizen. Well, the alternative is they also own the most amount of super carriers in the world, so they'd probably invent a conflict somewhere. But they've done that before. But yeah, that there'll be very interesting things that outside of interest rates, which is a very blunt tool, that will probably likely affect markets far more than just interest rates alone.
Yeah, and look, it might be Elon Musk to the rescue with, as you say, with the Doge. Maybe he can help the debt.
I mean, look, I think it needs to be done.
Yeah.
It's not going to be nice, but I think to get mildly political, I suppose, I think that government by polling and popularity polling is that's what's got them to there's every period in history we've had downturns in the economy, and the US, well, central banks just can't print their way out of trouble anymore to stay popular. The economic cycle is a cycle for a reason. We can't just stay up here forever because people get greedy. So and take too much risk. So the inflows into the leverage long ETFs, particularly Nvidia, the 3 times long ETF, is just frightening. It was $2 billion a month at one stage. I haven't checked the stats recently, but that's a lot of. No one's been tested yet, but it'll be like a good analogy a trader gave me back on the trading floor days was when everyone panics, it's like everyone trying to evacuate a burning building. It's like the door's only so wide, and some people get burnt.
Yeah, absolutely. And I was reading earlier this morning, you mentioned about BHP there just earlier on, and the phase to be able to sort of go back after Anglo-American is back again as well. They've sort of had that LSE period as well, so that might be quite interesting as well. We may see the move back for that at some point. That'll be interesting, especially after their sort of capex spending over the years. It'll be really interesting to see if they do move back for that and wish to spend maybe more money on that. Mark, I want to ask you a bit of a bold prediction for 2025. So we spoke a little bit about maybe what to watch. We've had resources. Maybe we might see those banks sell down, and we see that capital flow into resources. We're going to see AI sort of continue to develop and sort of really broaden into more industries. Any broad predictions that you might have? It can be anything, it can be wild, but something that you're looking at in 2025.
2025 for me is, I'm worried about the risks more than the rally. I think coming off the best 2 years it's not to say, like, the only other period in history where we've had that rally extend like that was leading into that tech bubble. But that had the advantage of rates coming down in the previous 10 years from 17% to 3%. So my bold prediction is I think the US gets a credit downgrade at some stage, and I think the market has a real genuine scare at some stage, particularly if we start to see these trade wars thing unfold. Look, I pulled together, 4, and it's probably a stupid exercise for me to do, but 4 potential black swans, because the whole reason a black swan's is because you don't predict it. But I don't like these private credit funds. I think all they've done is it's 2007 all over again with less transparency. US debt spiral, obviously, we've covered. And look, one thing that I don't think anyone's considered is the AI rally. 90% of those chips come out of basically one factory in Taiwan. China's got a history of blockading Taiwan, and they import 98% of their energy, and they only ever keep 7 days worth of energy, basically capacity spare. So a blockade could really, you shut down TSMC, you shut down the Mag 7. So it, and they've, whilst they've they're promised to do factories in the US, etc. There's no way they're going to do that, because why would you give the US has a vested interest in protecting them, so I can't see them moving that factory out. Nvidia can't get the precision manufacturing, so I would say my bold prediction is that I think we'll probably end the year somewhere up in the single digits, but I think there will be a genuine scare in the US market led by the Mag 7 at some stage over the next 12 months. What the catalyst is, I don't know, but it is. I think we're really ripe for. I think we're really ripe for a fairly significant pullback, and I think this year and its resilience this year and its ability to bounce back will mean that people will probably buy the dip. The first couple of times. I always say it's not a serious down market until you've heard people call buy the dip 3 times, and then the market's in trouble. So it's very difficult, and I do believe inflation will rear its head again next year. So my bold prediction would basically be that there'll be a rate hike by the end of next year. It's somewhere in the US probably, and I think this will be, everyone will wind back their rate cut expectations, and we may not, they're going to have to go back into to battle inflation again.
Interesting, yeah, that is definitely something to sort of keep an eye on, because obviously,
and not to scare people. Like, I don't mean but part of my job is sort of outlining the risks to people.
Absolutely.
Like, we spend so much time focusing on great companies to buy, etc. But sort of, I feel like it's my job to go, well, here's what can go wrong, not scare, which is a difficult job to do without scaring the crap out of people. But where we do a lot of planning with clients is those stocks that you really, really like, and you really think you're long-term winners. Write a list, pick a level, and don't pick a level close. Pick a level 30% down or something, and set a plan for almost an emergency plan. Because what I've found with my clients is, particularly if you know what the risks are and you've got a little bit of cash and you're looking to buy something that you've wanted to buy but it's been too expensive for ages, when everyone else is panicking, you're kind of you're licking your lips going, oh wow, this is the first time in 5, apart from the COVID fall, this is the first time in 5 years where you've been able to get quality companies at a cheap price. So the only place in the world where people get upset that the market's on sale, like it's a Black Friday sale and Equities is like a disaster, Whereas if you plan out and pick and don't panic and and you're really measured, a major pullback can be the best thing you do for your portfolio for the coming 3 to 5 years afterwards.
Yeah.
And you need to. Just spend a little bit of time. No, I don't think anyone focuses enough on just setting that little plan. If you're spending an hour researching stocks, make sure you spend 5 to 10 minutes setting a bit of a plan every now and then. So then at least when something comes out of left field, you know what to do straight away. You're not trying to think under pressure. But I used to own a trading house with proprietary traders, and we had 100 odd traders. That was one of the exercises that we used to do quite regularly, and just maintaining that calmness and that headspace when markets pull back. It was a really useful exercise, because you don't want to be the guy that sells the low, or the guy or girl that sells the low, and you don't want to be, and then you don't want to be chasing it when it bounces, and it's already bounced. So that's one big recommendation I'd probably say for people managing their own portfolios is just add a little bit of that to your routine, and stick to your high conviction stuff for the next year, because those high conviction picks will be brilliant, but markets will get noisy at some stage.
Absolutely, yeah. And as you say, we've sort of had great performance over the last 2 years. So it is a great time to just sit down, review the strategy, review stocks, why you own it, potentially rebalance, and then also, make that strategy as to, if we do get a sell-off, what are you going to do, and have that plan in place, because it keeps you having a level head, and you made that plan when you were in a good headspace. So
Exactly.
it's a good time to sort of remember that when things do get a little bit messy, and as you say, that noise is probably going to pick up. There's a lot happening in markets. I've had a great couple of years. Mark, all sort of fantastic points there, and plenty for everyone to take away. Thank you so much for joining us today, Mark.
No worries.
Look, thank you everyone else for watching, and a reminder to obviously follow the page, head over to the YouTube channel for the latest content, and if you need anything else from Mark, as I say, click on his Twitter. I'm sure he'll be happy to respond to any questions you might have, and of course listen to the podcasts. Just search for Digest and Invest. Thank you everyone for watching, and have a Merry Christmas, and we will see you in 2025.